Tim Vollans, welcome back to F.A.C.E. Happy New
Hey
Year
Dale,
to you.
same to you, mate. Same to you.
Are you going to be screen sharing it all today, Tim?
I'm just going to do it now. Yeah, I'm going to bring it up.
Okay, so Tim, I get your emails for, that you put out and, talk about what you're seeing and what you're doing. And you've been busy going to a lot of investor conferences and doing some intelligence gathering, but we can
Yeah,
get to that. Okay.
Yeah, we do. Yeah, no, we do a lot of that. We do a lot of that. Just sort of trying to get the feel for what the market's doing, I suppose, is really our main job.
Okay.
What people are thinking about. But yeah, it's certainly.
You even put
I'll
out
be
some
honest.
picks. Yeah.
Yeah, you can have some picks, of course. Yeah, I mean that's if you're not doing that, then where's the interest?
Yeah.
But
That has to be actionable.
yeah, for sure, for sure. But yeah, I mean, just looking at the response here, it's this has been pretty definitely a sell the fact reaction was kind of expected, I think, but this is maybe a bit stronger than that, you think?
Yeah, look again, breaking the new lows.
Okay. Yeah. So yeah, but it's
so what are you thinking about
the time.
Okay, so what are you thinking about the change that took place at the BOJ?
I'm yet to be convinced fully that they're going to sort of follow through with it, but there's a lot of things that I think we're doing at the moment that we maybe I think we're looking at different time horizons. We're focusing very much in the present right now. I think time horizons are short, and I think they have been for a while now as well. That just because of the uncertainty generally, you're trying to sort of get a view on the future and you can't. So really, all you're left with is what's going on right now, and we're sort of doing our best to focus on one thing at a time. I think in the market, and for now, that's been inflation. But I think that when we go down the line and we start looking at growth and global growth and everything else, I'm not sure that we're going to really push on as much as people are hoping. I'll tell you what, actually, I saw the perfect chart that I was going to bring on here to kind of illustrate. There we go. I sent this one out earlier. Okay, so this one's via Ruffer. So we've got all of these expectations that are still here, that we're going to get the Fed fund rate, just below or around 5% as a peak. We're going to have this soft landing, this Goldilocks kind of economy for a while. Inflation is going to come down quickly, but we're still going to have earnings growth and stable margins and all of those things for companies. And I think it's very hard for all of those things to be true at the same time, as Ruffer kind of hint at here as well. So yeah, that's sort of is the big thing that I'm watching now, is that I think at some point, and I don't think it's yet, but I think at some point the pivot to the kind of the real growth fears, the kind of like, actually this Goldilocks thing we're gonna go too far. I think that's the trade really for this year.
Okay. All right. Yeah. It's hard to have all those things happen at once.
Yeah. Exactly. And I don't, from what we're hearing at the Fed as well, I know obviously they've got to talk tough and, so you've got to take everything they say with, a truckload of salt, but I do think that they're genuinely worried about repeating the mistakes of the 70s or 70s and 80s, perhaps, where, in the whole Volcker era and everything else. I think that's on their mind, and that's probably going to be the thing that will keep them tighter for perhaps longer than they need to be. But on the other side, again, I don't know that there's much they can do. They can't do anything other than that, because I don't think that they can confidently say, oh, we're going to start cutting rates again until the animal spirits have been squashed.
Okay. So this might be a pretty good area to sell. I know some people have expectations for 4,300 before we get the unwind of Goldilocks. And she has her pigtails cut off. So you have any levels or that you're thinking or timing? The consensus opinion coming into this year was for the bears, that we were going to take out October's lows here in the first quarter, and then the rest of the year would be okay. And that's a pretty crowded narrative. Do you agree with that narrative? Or because everyone's thinking that, maybe we're okay until through the first quarter and the problems come later?
Yeah, I think actually it's the opposite way around than the kind of the consensus, as is so often the case. I think actually we're probably going to be okay in the first half of the year. I think that's where we're going to get these hopes of the Goldilocks
Okay.
sort of soft landing narrative is going to take precedence. I think that
Sell
seems
in
to me
May and
more
go away,
likely.
Tim?
Yeah, I think that might not be the worst idea in the world, to be honest. I know it's a cliche, but yeah, that makes a lot more sense to me, because I just don't see where the continued upside is going to come from. If you think about you look at the whole picture, and you've got, governments that obviously now governments have got to finance themselves. Okay. So they no longer can rely on their central banks, certainly to the same extent as they previously could, to buy up the debt, which means that the private sector's got to absorb a lot of this, which is fine. Generally they're paying better yields and everything now, so that can happen. But all of that money's got to come from somewhere. And at the same time, you've got this kind of global quantitative tightening going on, where central banks are also selling or allowing bonds to mature, which sort of takes the weight of that. And then you're looking at that kind of world where, okay, so where does the money come from for those things? And it has to come from, shall we say, risk-taking activity, such as buying stocks. And I think the longer it goes on for, that you see the kind of probably the Goldilocks roll over into something else, something less optimistic, then obviously the more attractive government debt looks, which kind of, it's going to keep those flows going, I think, away from riskier assets and into, safer ones like government bonds, which are paying much better yields than they have done, especially as inflation rolls over. I think it's still going to be sticky on the way down, definitely. I've got a silly little image. I don't know if I've got it here.
So you're kind of like
my model.
Oh, I like that, the bullwhip. So
yeah, but it's the opposite way around. Yeah.
Yeah. Who's the guy?
I just literally found, I was looking at the bullwhip effect, and I was thinking that it's basically the way I see inflation getting back to 2% is kind of like the inverse of the bullwhip.
Okay.
So we're starting out with this pandemic where you've got this real kind of real volatility, in everything between the imbalance of sort of supply and demand. And then gradually, as we want to bring the economy back towards this stability, then that volatility will decrease over time as we get back there. But it's still going to sort of go up and down along the way. And that's my kind of
how many years model. How many years till the reverse bullwhip effect takes place?
Honestly, I've got absolutely no idea for that, Dale. I really, really don't. There's so many views, there's so many predictions, and so many ways of sort of taking what's happening now and reframing it. It's like, is it down to this sort of, is there like a structural secular labor shortage that means that all of a sudden labor's, going to have this power to bargain for wages, and we're going to see, higher wages and higher inflation become a permanent feature? Or,
we need to roll out the robots.
But even then, that's always been going on. We've always been looking at using technology to get more productivity and more out for less, and then we just go and find more things. Like we've had an exponentially growing population, and we've managed to find work for most people. So, I don't think that even solves it, shall we say? I just think that it's that we've been through one long period of time where that wasn't a problem, and now we're getting to a point where it's probably going to be a bit more of a problem. But I'm finding that because there's change, there's this real kind of battle for like a new narrative of this is the big change, everything's going to be different, and all of those things. And I'm sympathetic to some of the views that go alongside that, but I don't see that everything's going to be different. It's just going to be a bit different, as things always are over time, rather than like a sudden change.
You're not a proponent of the big reset.
No, not really. And I mean, even if I was a proponent of the big reset, then it's going to take like 10 years before you really notice it and then go, oh, that happened. You can look back and see and go, yeah, no, that was something that really did happen. I don't think it's something you can see happening in real time. I mean, like if you look at like any of the kind of things about reshoring and nearshoring, and you look into those projects, and like take Apple as the biggest example, how long it would take for Apple to really take the majority of their production away from China. You know, you're looking at a decade. These things are like slow moving tankers.
Right.
It doesn't just immediately happen. So I do definitely agree that there's a lot more uncertainty than we've seen in recent times. And I do think we're going to see a bit more volatility in general. I don't think we're able to rely on just this kind of stable, low inflation world like we once could. But I don't necessarily think that means it's going to be completely different either. So I just think that, you know, many of the same themes are going to apply that we've seen in the past, but maybe not to the same extent as they once did.
Okay. Anything else top of mind that you want to share?
I'll be honest, let's have a look at, there was a couple of things that I had here in mind. There was, where are you?
Any comment about the tremendous upside move in the gold miners?
In the gold miners, I don't.
I know you're not a real big proponent of gold. We've talked about that before.
We have talked about this, and the gold miner thing as well. Like, I don't know that the relationship's as I don't know. I find it a really weird relationship to kind of observe and draw conclusions from the relationship between gold miners and the gold price, you know, and how they trade. Because obviously it's always people's, especially in the gold mining, it's always people's expectations of gold prices that seem to drive them. So yes, we've seen them, and yes, we've seen a big upside move in gold as well. You know, if we zoom out a bit here, you know, gold's had a lovely recovery down here from the whole, you know, this sort of triple bottom kind of area. But I mean, again, I look at where it is, and I think it's coming into a real resistance cluster up here. You know, yes, you're above the 200-day moving average, but I don't know whether this is gonna sustain enough, and we're gonna see this tick up.
I'm short today.
Yeah, I don't blame you considering where it is. You know, I don't know. Maybe we get a bit more of a squeeze. You know, just purely on more dollar weakness. I've seen that the euro's ticking up there as well. But yeah, in terms of like a theme to trade, I don't see the case for more and more gold upside.
How about a dollar bull or bear market in 2023?
Yeah, again, I think it's going to be a much more of a push and pull environment this year. I don't think we're going to see the one-way trade that we saw for most of last year for the dollar at all. I mean, I just think that's what it's going to be. We're going to go between, I think, the kind of the panic of, you know, oh my God, you know, there's no growth, the economy's slowing down, to, oh, actually, no, the economy's doing fine. You know, inflation's getting lower. This is good. And then we're going to go back to, oh my God, that means that we're going to collapse, and because the economy can't take it. And we're just going to play that thing right the way backwards and forwards through the year, I think, is the most, that's sort of my base case.
Okay.
I don't, you know, unless there's real concern about the economy, I don't see the case for dollar strength. Actually, that's wrong. There's two scenarios I see for dollar strength. The one that's most likely, I think, is that, and you know, we've got this Goldilocks situation now that I think is going to sustain for a little while, which is generally going to be dollar weakness, just because it's kind of, you know, and you've got the dollar smile, you've got global growth, you know, and if you think about actually talking about the dollar smile, let me just bring it up.
You're in the UK, right?
I'm in Spain, actually.
Spain. Oh, okay. So you went for a nice climate. Are you near the beach?
Yeah, 10 minutes back.
Oh, nice, man. Where did you move from? You were from the UK?
Yeah, I was from London originally.
Okay. How's your lifestyle? Loving it there in Spain?
Yeah, it's good, man. It's good. Yeah, we've barely had to use any heating this year at all.
Oh God, I'm getting killed on my natural gas bill.
I can imagine.
Here in California, they can't
although they're coming down a lot. They're coming down a lot, prices, aren't they?
Not here. Yeah, so it all depends if you have access to supply, and that's on the West Coast. They're having problems. So
yes,
anyway, okay, here's macrodesiac.
Yeah,
nice stuff here.
Yeah, so the sort of the general idea. I think this here is where I see that we are sort of currently. You know, it's a perfect.
Yeah.
You know, kind of example of it, you know, global growth. You've got China reopening. You've got, you know, Europe's not doing as badly as everyone feared that it would. You know, the gas crisis has basically been avoided. You know, so the dollar's weaker. You know, we've moved off down into this area of the curve here. But then you've got the two scenarios that, you know, you've got basically global growth suddenly weakens. You know, which you know, I think is quite possible. You know, perhaps beyond expectations, but and the fears really set in. Then obviously you're going risk off, you know, and you know the dollar's going to catch a bid, you know, as everyone seeks out sort of dollar bonds and everything.
Okay.
But the alternative is also that actually US growth ramps up again. You know, that's the other thing that I kind of, it's there in the back of my mind, but it's not really my base case. You know,
the best
there's
dirty shirt again.
the best dirty shirt, yeah. But in this, yeah, that's it. You know, and the dollar sort of starts outpacing everyone else again. You know, if you get this little boost from China reopening, you know, there's probably not the spillover I think that a lot of people hope there will be from China into the global economy. It's going to help a bit at the margin, but I don't know that it's going to be a kind of like a
Copper certainly
sudden.
think so.
Copper certainly, but I think that some of that is also from the property sector, I think, as well. You know, they've said that they're going to support the property sector. They're going to make sure the systemic, you know, the systemically important developers can yeah, I know. You know, this is the thing where I'm sort of really skeptical about all of this. You know, they've made a hell of a lot of promises in China, and that's what they do. You know, often they make a lot of promises and everything else, and I think ideally they'd like to be able to follow through with them, but the real world tends to get in the way. You know, so I just don't see that they're going to be able to really push on with their economy to the extent that the rest of the world can really benefit from it, because you know, a lot of it was property driven, and they're not really going to push the property sector into growth again. They're just going to stop it from decelerating if they can. You know, that's the intention. You know, it's to support it in that way. So yes, it does mean the projects you're going to get finished. You're going to get some more copper demand. You know, they're looking at obviously doing more green energy as obviously everyone is in the world, which supports copper. But I think that's got limited legs. You know, I really do. So yeah, I think that's the other situation with the US. There's the kind of in the back of my mind the economy there. Obviously, if you bring inflation down, but you've still got this sort of slight imbalance between supply and demand of workers, then what can happen is that actually, you know, real wage growth, which has been negative, you know, when you adjust it for inflation, you know, wages weren't going as far, but that didn't matter because we all had those sort of pandemic savings to sit on, you know, and draw down on. But now that the savings are going down, we might actually get another boost as basically wages continue at roughly the same kind of rate, but inflation falls faster. And then obviously you've got sort of more purchasing power for the people again that, you know, that are bringing the money in and most likely to spend it. They're actually getting more purchasing power, and it could see the economy ramp up again. And I think in that scenario, you're really going to see, you know, you're going to see the dollar probably outperform.
Okay. All right, so best place for people to follow you on Tim at Volatim,
yes,
or
yes,
at macrodesiac.com.
Both. Okay, so at Volatim on Twitter. It's slightly less serious, to be honest, in the Twitter on the Twitter follow. But yeah, then every day, you know, we're sending out information. We've got guides. You know, if you look here, like this was actually written for us by some bond traders. Yeah, David published it, but it was actually written by, I don't know, do you follow the guy Efficient Market Hype, Market Hype?
No. Who is he?
Okay. He's a bond trader over in Asia. He's got some serious depth and knowledge, and he's also been helped on it as well by a few other guys. Which it's all bonds and credit. You know, so that's free. You know, and we try and take everything and just break it down into nice, simple, you know, kind of context. You know, put context to things, break it down into simple kind of language, and kind of demystify the whole kind of finance jargon and complexity that really. You know, it really isn't that complex. You know, it's complex to kind of piece it all together, but you know, the individual things really aren't as complicated as they often sound. You know, so we're just sending stuff out every day. You know, so yeah, follow us.
I got some of it, and Tim and Peter, they do what their name of their company says. They do great macro, and make it able to digest it and comprehend it for people that don't have a degree in economics. So keep up the good work, buddy. And I hope 2023 is a great year for you and all the people that read your stuff. And I look forward to talking to you again down the line.
Likewise, man. Thank you.
All right, Tim. Tim Vollans, everybody. Check him out at Volatim and at Macrodesiac. And you could join the team in about, let's see, 22 minutes on the morning edge. Don't just count your pips, count your blessings. We'll see you to wrap up the week, TGIF tomorrow. Thank you, Sinatra. Thanks again, Tim.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.